Two of the largest bank failures in history happened this week.
We begin with the banking turmoil and new details about Silicon Valley Bank.
In less than 2 days, it collapsed, and the government stepped in to take it over.
Of 3 banks in a matter of days.
First Republic shares of the struggling bank are up about 40% after losing nearly half of its value during trading yesterday.
And reports tonight of a major financial merger overseas. UBS in talks to take over parts or all of Credit Suisse.
We're at the start of a banking crisis. Over the course of the last few weeks, we have seen 4 major banks failing, 3 in the USA and 1 very large bank now in Europe.
Be very afraid of banks. A lot of people in their videos break down, the fundamentals of what's going on with Silicon Valley Bank and all the other banks that have failed in the recent months. But in this video, I have a different perspective and a different agenda. I'm going to talk about how to pivot your perspective from an average Joe to a 1% entrepreneur. And no, I do not support the exploitation that these banks are exhibiting, but I do want to break down how not to fall victim to their corruption. Let's get into the video.
A rough week for the banking industry.
The collapse of Silicon Valley Bank is causing shockwaves across the entire business world.
A big bank just died. We've all heard about it. Everyone's talking about it. And we got to talk about it because something big is going on here.
As of this morning, Silicon Valley Bank, or SVB, has gone under completely.
The second biggest bank collapse in U.S. history.
The bank is called the Silicon Valley Bank, or we're going to call it SVB in this video.
It is the epicenter of tech startups, venture capital.
And it is now effectively dead. The government is scrambling to keep us all calm while this bank fails.
Your deposits will be there when you need them.
The American banking system is really safe and well capitalized.
That's because we live in a system that doesn't work if everyone freaks out at the same time. The system relies on all of us keeping a feeling of safety. If that doesn't happen, the system falls apart, and that's what I'm going to explain today. So, let me show you how this happened, how this bank failed, and what it means for you and me. But more importantly, how this moment teaches us that our bank accounts are kind of a lie.
We're going to have to do something different here.
We're actually rescuing depositors in banks that made some bad decisions over the course of the last year or so.
Americans can have confidence that the banking system is safe.
Okay, so let's talk about banks.
All this is done with credit. Credit created by the bank out of the deposits made by all of us.
Banks are actually pretty nuts. We think of a bank as like a place where we take our money and store it. Like we give our money to the bank people and they go put it in a giant vault and it is safe until we need it. But that is not what is happening. In reality, banks are doing something pretty magical when you give them your money. What they do is actually at the heart of our modern society, our modern economy. It's what makes a lot of things work. Let me explain.
Well, let's get a little bit more insight on the collapse of Silicon Valley Bank.
Okay, for this, let's get back to the old collage of the macro economy as we've done in previous videos. Let's say I put $10,000 into my bank. What's insane is that the bank only has to keep 10% of that money in the actual bank. 10%. So that's like $1,000 of my $10,000. The other $9,000 they can go out and invest with and make money on. Using my money, they can go invest it. This often means giving out loans to people and collecting interest. Okay, so 9,000 of my dollars gets loaned out to, let's say, a baguette business who is in need of a business loan because they need a new oven. My bank gives the baker my money and charges interest on that loan. And they actually give me a little bit of that interest that they've made to say like, hey, thanks for letting me use your $9,000. So the baguette business now has 9,000 of my dollars. And I don't actually know this because I kind of think that my money is in a vault somewhere. So now the baker with his new loan goes and buys his oven for $9,000. And the oven seller takes that $9,000 and goes and puts it in their bank. And guess what? Their bank does the exact same thing that my bank did with my money. But now they're doing it with their money, which is kind of my money. They only have to keep 10% in their vault. So they only have to put $900 in the vault. But now they've got $8,100 that they can lend out. And look, there's a family who's looking to spend money on a home and they need a loan. Okay, wait, are you seeing what's happening here? I gave 10 grand to my bank And now that money has magically duplicated a few times to make more money, like real money that can be used to buy things, an oven, and then a house. This continues to happen over and over and over. My 10 grand just keeps getting used to be lent out, put into another bank, and then lent out again. In fact, if you model this out on a nerdy spreadsheet, which is something I like to do, you'll see that if I deposited $10,000 in the bank, $10,000 is added to the system. But then for each one of these transactions, more and more money gets added to the system. This is the aggregate of all of the money being added to the system. My $10,000 turns into this. Look what happens. Look, it just keeps going and going. And eventually, it effectively 10x's. It sort of flatlines out at $100,000. What? My $10,000 just turned into $100,000 into the economy because of weird mental constructs? Yes, that is our modern financial system. It is amazing, and it's kind of mind-blowing. Okay. This magical thing is called the money multiplier effect, and it relies on the reserve ratio, the requirement that banks have, like the amount that they have to keep in this case 10%, which is like the real reserve ratio right now. You can do this calculation, it's like 1 over the reserve ratio, and it sort of gives you this multiplier effect of your money. The crazy thing is, the lower the reserve ratio, like if your bank only had to keep 5% of your money in, the more money would be created out in the economy, but the riskier that would be for you. If the reserve ratio was like 50%, if they had to keep 50% of your money, then like that's safer for you, but now you're not like priming the pump of like giving all of this money to the economy to like make transactions and build businesses and build capitalism. So the reserve ratio is like 10% right now, which means that a bank that has $100 million from all of its customers really only has to have $10 million in its vault at all times. And the other 90 million is out doing its work in the economy, multiplying itself and making a return for the bank and giving you a little interest rate. And the bank is secretly the whole time like, please everyone, don't come withdraw your money at the same time because we don't actually have it. Just please, thanks. Okay, so this is slightly scary, right? Like the bank only has 10% of my money? Feels kind of risky. I thought banks were like the safest place to put your money. It's not like I'm doing some hardcore like risky stock investing. Maybe I should take all my money out of my bank account and put it under my mattress so that the bank isn't like playing around with it. Well, no, let's actually not do that, please. Because if we did, our economy would miss out on this amazing, magical multiplier effect that turns my 10 grand into 100 grand. And our economy would literally be a fraction as prosperous as it is. The reality is we don't have to worry.
The US system or capitalism needs this system for it to work, right? It needs the mass populations to put their money in banks. I think about economies like Nigeria, for example, where people don't want to put their money into banks and, you know, capitalism doesn't thrive there. But in America, it needs to happen. Now, he's giving you this video from a very consumer perspective for the average man to understand capitalism and how to feel secure in the system of capitalism in America and feel secure in the American economy. That's the purpose of his video. My video, this video that you're watching right now, is going to focus on how to beat the capitalist game so that you can be in the 1%, right? So stay tuned. But the basic principle here is that security, that the middle class and the poor want security. As an entrepreneur, as somebody that aspires to be in the 1% or that is in the 1%, it's not about security. That's not what you're focused. That's not what you're focused on. Right? It's not what you're focused on. So let's finish this off. This video is to keep you secure and trust in the U.S. economy, which is important. We need the masses to be secure so that we can make money off of them. But let me keep going.
Okay, so banks only hold on to 10% of my money and the other 90% they are investing in the world. And this is kind of scary. Governments know that this is kind of scary, and they also know that our society and our economy is built on us keeping our money in the bank, not freaking out, not everyone all of a sudden going and pulling it out. So to make us all sleep better at night, they promise that if a bank ever does anything reckless with our money or they accidentally lose it, while they're out there investing, that the government will make up the difference, that the government will pay us back for any money that we lost, at least up to $250,000. It's kind of like a everyone stay calm, we'll pay you back if you lose it, just don't everyone go at the same time and pull out your money, please. The whole system relies on it. Can we just chill? And we can chill, as long as we don't have more than $250,000 in our bank account.
And the FDIC's Ricky McCullough stood at the front door. The people who were coming in this morning, what were they asking you?
Can I still write checks? Can I access my safe deposit box? Can I use my ATM machine?
And to all of those questions, you answered what?
Yes.
Customer Bill Hess showed up on a mission with an empty briefcase. He intended to leave with all of his money.
We'd be glad to answer any questions for you.
I don't care anymore. He said, I don't care anymore.
And so I became a little concerned. So I came inside. And one of the things that he told me as he opened up his briefcase, he said, well, I don't have a gun in here. So I said, well, that's good. I can't wait.
McCullough explained to Hess and his wife Audrey that their savings were safe.
So if you have a single account, that's $250. If you have a single account, that's $250. So now that's $500.
Hess's briefcase was empty when he came in and empty when he came out.
We just thought we were going to see closed and the doors locked.
Yeah.
You know.
So how do you feel now that you've talked to them?
It's fine.
Assured.
Yeah.
Assured. Yes.
You feel
fine.
assured?
Yes. Yes.
You had confidence in the FDIC.
FDIC, right, yeah. Now, if they can't pay you, then I won't have confidence in them either.
Fear created the FDIC in 1933 after the Depression set off panics that wiped out even healthy banks.
We've been around for 75 years. Nobody's ever lost a penny of insured deposits.
No depositor has ever lost a
deposit.
penny
No.
since the FDIC went into business.
That's right, of insured deposits. That's absolutely right, which is why you need to make sure you're below the insured deposit limits. But no one's ever lost a penny.
And the insured deposit limit is what?
Right now it's $250,000. That's the base limit.
When the FDIC comes in and makes depositors whole at a bank that has failed,
Right.
is that tax money?
No, it is money from our reserves, and we are funded by insurance premiums that are assessed on banks. So no, it is not taxpayer money.
It's okay. The banks are going to be bailed out, and it won't be at the taxpayers' expense, which we all knew was a lie. It would be at your dollar's expense or your deposit's expense, in the respect that the money had to be created out of thin air, and we just figured that would mean more inflation.
Bear warned 2 years ago that bad mortgages threatened the financial system. Now she's managing the biggest bank failures in years, including the collapse of Washington Mutual and last summer's sudden failure of IndyMac in California.
We were told we would get in.
Stay open an extra hour.
When IndyMac failed, you were watching these scenes on television
Yes,
of
I
people
was.
lining up outside the bank like it was 1932.
Yes, it was. It was
What did you
amazing.
think of that?
So I think people just forgot that banks do fail and how the FDIC works. Their money was safe. It was safe. It was probably the safest place in the world to have your money because we were operating an institution at that point.
What sort of hit was that on your balance sheet?
I think we ended up it was over $9 billion for a $33 billion. Yes, it was very stiff.
The question becomes, how many times can the FDIC do that? At what point is the FDIC broke?
The FDIC is backed by the full faith and credit of the United States government. So if we need to, we try not to and don't want to, but if we need to, we can borrow from Treasury to make up for any shortfall.
So the FDIC never goes broke?
We don't go broke. No, we are the government. We're backed by the full faith and credit of the United States government.
The FDIC can't handle this. Their insurance fund is only 0.03% of bank deposits. 0.03%, roughly $125 billion in FDIC liquidity backing over $9.5 trillion in deposits, with about $125 billion in cash. That's 0.03%. So if just one or two banks fail, that's it. That's gone.
So in the wake of this crisis, we're learning that the FDIC actually could expand its coverage and insure Americans beyond that $250,000 threshold that you've been talking about with us daily. Is that what you're hearing?
Well, I think it's a long way from becoming a reality, but it's certainly something the Treasury Department will consider, and it would go a long way in boosting confidence in our banking system. Janet Yellen, Treasury Secretary Yellen, was asked about this today when she addressed the Banking Association, and she said there will be a time for us to look at those rules. Right now, though, we want to stabilize the banking system. Fed regulators, by the way, would probably need emergency authority to ensure deposits above of $250,000 without the consent of Congress. And as we know, we have a very divided Congress. It would be hard to believe something like this would actually pass. Republicans are already pushing back on this idea.
Anyway, this is kind of works for most people. Most people don't have $250,000 lying around. But what about businesses? Businesses have to use banks. They have expenses every month like payroll and rent. A tech company like Roku had $500 million in Silicon Valley Bank.
And at this time, the company does not know to what extent they'll be able to recover that cash.
Companies like this need way more than $250,000 to cover their costs.
And let's remember, guys, did you see how their stock dropped just because people know that, their shareholders knew they lost out on this? Their business lost out on it. Look at how drastically their stock went down. It's crazy.
So the question is, how do they feel safe? And this is where we get back to Silicon Valley Bank. These dynamics become very strange when you're talking about the customers being a bunch of businesses.
Do you have money jitters? Ask your nearest Bank of America branch for a jar of soothing instant money.
Okay, so Silicon Valley Bank is the bank for businesses, particularly tech startups in California. And unsurprisingly, 90% of their customers had more than the $250,000 sort of mark where the government will insure you. So a lot of that money is not insured by anyone. They just trust their bank. And that's fine. Banks aren't out there taking their customers' money and making super risky bets with it. This bank has been operating for 40 years and it's been doing just fine. But what happens next is a perfect storm of events that led this bank to sink.
Where is he?
Peekaboo.
Let's make a list for this. Here we go.
The anatomy of a collapse of a big bank.
First, they invested a lot of their customers' money, like every bank does. In this case, they invested in government bonds, which is a totally safe investment. It's an investment you put your money in for a certain amount of time, like 10 years, and the government will pay you interest on that money based on the federal interest rate.
The Treasury takes on debt to cover this difference. They do that by selling securities, like say a 20-year bond. An investor gives the Treasury money, and the Treasury would pay interest on that every 6 months. They'll do that until the 20 years is over, and then the investor will get their money back.
The thing is, though, when SVB bought these bonds, it was like last year and the year before, back when rates were very, very low. Okay, not a great return for them, but it was fine. It was a safe investment. If they just waited out the time period of the bond, they would get all their money back plus a little return. Okay, but then what happens next?
Economists expect a rate hike of 0.75% to help drive down inflation.
The government starts to raise interest rates. They're doing this to help stave off inflation, stabilize the economy. The government is doing this thing called raising interest rates. That's fine. But what it means is that people buying bonds today are going to get a better rate of return. Those bonds are more valuable now today. So SVB, who bought their bonds a couple years ago when interest rates were super low, and if they ever wanted to sell those bonds early, they're now competing with interest rates that are a lot higher, and so their bonds are actually worth much less. If they had to sell them today, they would lose money. Okay, but again, that's fine. Just hold on to your bonds until the whole maturity schedule happens, and then the government will give you all your money back with your little return. Everything is okay. Okay, but here's the next part of the perfect storm that really starts to heat all this up. Remember that SVB's customers are startups. Startups raise money from venture funds, and they take that money and they deposit it into SVB, and that is how SVB gets its money to operate, to invest with. But during this recent economic downturn, startups haven't been able to raise as much money, and thus SVB hasn't had as much money coming in the door. And so they start pulling on their reserves, and they realize they kind of have to figure out a way to get more money. And it's not going to come from startups because startups aren't raising. So they turn to their bonds. They're like, we've got tons of our customers' money in these really safe bonds. They're at low interest rates. We probably need to sell some of them off to get some cash in our reserves to meet all of our needs and the withdrawals and all of that. So they sell off a bunch of their bonds. And this is where things start to go really, really wrong.
So all of these banks over the last several years have accumulated with the deposits that they received since the president was able to remove all of the reserve requirements during the pandemic to zero. So most of these banks have virtually nothing in the way of currency on hand. And because they would take these deposits that came in from the depositors, and they would buy bonds with them, typically treasuries and in many cases mortgage-backed securities. at rates above what they were paying, of course, to the depositors, but in what was typically considered safe places to be. The problem is all of those bonds have an average maturity or an average yield rather of about 2 to 2.5% and long maturities. And so the problem is that since interest rates have risen closer to 5%, every one of those bonds in their portfolio have lost 50% or more of their value. Now, the banking regulations say that they don't have to mark those to market until they sell them. And so they have a whole balance sheet filled with toxic assets that have lost over half their value or more.
They announced that they're selling their bonds and they have to sell them early. And yes, we bought them at a lower interest rate and now the interest rate is higher. So we're actually selling them at a loss, and that loss is actually $2 billion. Okay, like again, banks have to deal with this kind of stuff. This isn't great for them, but it's far from lethal. But then, this is where it starts to get really bad. They go out and announce that they're gonna be raising money from other investors. They're like going out looking for money. They're like, hey, yeah, we sold off the bonds. We also need you guys to invest in our bank so that we can just stay good. Everyone stay calm, it's not a big deal. We just need to raise a little money. Everyone stay calm. The best way to like get people to freak out is to be like, stay calm, it's actually not that big of a deal, we're fine. We just need to raise some money and we're selling bonds at a loss.
Oh my God, okay, it's happening. Everybody stay calm. What's the procedure, everyone? What's the procedure? Stay calm!
Okay, so now the moment that deals the final blow to all of this. All of these founders and venture firms, they're all talking to each other because they're all in the same community, in the same area, all in the same business. They're all in the same WhatsApp groups, and they're all like, hey guys, what's going on with SVB? All of our bank, why are they raising money? Why are they selling their bonds early? Is my money not safe? And so, like a herd of bison frightened by a loud bang, a stampede of very wealthy founders and startups in Central California start pulling out their money from SVB, trying to stay safe.
What you're seeing behind me is customers of Silicon Valley Bank lined up to make sure that they can get their money.
They know that their accounts aren't insured by the government because they have way too much money, and so they don't feel like their money is safe. And they take it all out.
I need money. How am I going to live until the bank opens?
I got doctor bills to pay. I need cash.
I can't keep Americans on faith. I've got to have it. How much do you need?
On Wednesday alone, customers pulled out $42 billion, which was a quarter of what the bank was worth. Word spreads to Wall Street that this is happening, and SVB's stock begins to tank.
Long story short, the FDIC have decided, or Biden has said they're going to bail them out. And so as a result, well, they're not using the term bail them out, but their money is secure. Biden says everybody gets access to their money. He told everybody that, the bank was basically, Silicon Valley Bank was taken over by FDIC. They renamed it, and they've told everybody, Biden has told everyone, look, you're going to get your money back. These companies that have hundreds of millions of dollars. So that keeps them secure. And it's so important. This system in the US, it's so important that people feel that their money is secure. If they don't feel their money is secure, they're going to keep their money elsewhere.
Many were quick to point out that, once again, the government only seems to step in to help a certain type of person. Quote, Mark Cuban, bail out Silicon Valley Bank tonight. Feds, approved. Goldman Sachs needs $824 billion. Approved. JP Morgan Chase needs $416 billion. Approved. Average Joe, my wife has cancer. Can we get Medicare? We're broke.
So here's the thing, right? When it comes to the average Joe not getting, that insurance, health insurance for their wife's, cancer or whatever, diseases, or even just like a small business not getting a bailout from the US government. But these big businesses, these big banks always get bailed out from the US government. And so why do they have this unique opportunity? Well, because number one, they create industry in the economy, right? This is a bank, they're loaning money to businesses to generate more income, right? So they're facilitating growth in the US economy. Number two, these banks are typically investing in bonds, in US Treasury bonds and all sorts of bonds that invest in the US government and allow the US government to fund their wars and fund all sorts of different sectors, including healthcare, Medicaid, Medicare, right? So These banks are extremely lucrative to the US government, and more importantly, the US government want to control perspective. Remember that the dollar is not backed by the gold standard anymore. The dollar is backed by what? The trust of the US economy. Now, if every US citizen starts taking their money out of banks, what do you think is going to happen? What do you think is going to happen to the banking industry, and therefore what do you think is going to happen to the US economy? The real issue here is PR and the fact that not just Silicon Valley Bank, even Wells Fargo, even Bank of America, in this year 2023, we've heard stories of people not being able to get their money out. People have fear of the banking industry in America. People are afraid. And that is exactly what the US government does not want to happen. They want you to trust in the banking industry.
Every community bank in Oklahoma, regardless of their size, be fully insured now. Are they fully recovered? Every bank, every community bank in Oklahoma, regardless of the size of the deposit, will they get the same treatment that SVB just got or Signature Bank just got?
A bank only gets that treatment if a majority of the FDIC board, a supermajority of the Fed board, and I, in consultation with the president, determine that the failure to protect uninsured depositors would create systemic risk and significant economic and financial consequences.
So deception, betrayal, collusion.
Yes.
What did Janet Yellen say? She says, who's going to decide who lives or dies?
It will be her, the overwhelming majority of the FDIC board, and members of the Federal Reserve. So they're going to decide which banks are worth saving and which banks aren't. And we all know which banks they're talking about. These are the commercial banks. But step number one is to get everyone out of the small regional banks out of fear, herd it into the big commercial banks, and we are seeing a massive consolidation. And that's exactly what is happening, because they are going to pick and choose who they backstop and who they don't. And this is, you can't even make this up. This is something that is so crazy that I think it's going to have rippling effects throughout the entire banking industry. And you will see bank runs, and a lot of them. And I think they will start in those small regional banks.
All right, I'm editing, and I just realized I didn't conclude this video. So the US government they have to, at least with the first slew of banks, they have to at least attempt to bail them out and see what happens, right? So that's on one hand, right? But the problem is that if this continues to happen, they're not going to be able to afford to keep bailing banks out. Like he said, they have like one or two banks, and they can't keep doing this. So they have to focus on propaganda. They have to focus on making sure the world trusts the US. They have to focus on making everybody feel secure. And so if the US government does not bail out Silicon Valley, this is just going to encourage people to take their money out of banks, and even to take their money out of the US, investing in cryptocurrencies, stable coins, investing in other economies, and getting other countries to pull their money out of the US. The US government absolutely does not want that to happen. So they have to bail these banks out. They absolutely have to. So it's completely different seeing it in that perspective. So I ended up making this into 2 videos. It was only supposed to be 1 video. It's super long, so I'm gonna cut it up into 2 videos. Stay tuned for the next video. In the next one, I'm going to break down how you can avoid getting scammed and how you can use this as an opportunity to make a lot of money. Stay tuned.
We begin with the banking turmoil and new details about Silicon Valley Bank. ABC News obtaining new audio of then CEO Greg Becker downplaying financial risks just days before the bank collapse, the second biggest bank failure in U.S. history. Financial filings showing Becker sold $3.6 million in Silicon Valley Bank stock late last month. Sources confirming to ABC ABC News that the Justice Department and the FBI are investigating the bank's collapse, allegedly focusing on possible insider trading.
Credit Suisse, that we've been talking a lot about, says it will continue to hand out bonuses and pay raises to those eligible.
People still get paid. People still get their commission. People still get their bonuses on your money, but you don't get your money. This is why one of the #1 rules is if you want to invest, you have to be